This is a story of how I grew my TFSA portfolio from $2,000 to $13,000 in 1 year. So in this video, you'll learn how I got here, the setbacks that I encountered along the way, my highest conviction stocks in my portfolio, the keys to investing for the long term in individual stocks, and last of all, if you guys are curious, what's inside my portfolio as of today. A year ago, I posted this video. This was the challenge video that I set out for myself for the next 3 years to grow my TFSA portfolio from $2,000 all the way to $50,000. And how I would do this is fairly simple. Deposit $200 every single week and invest that money consistently into my highest conviction stocks. If you guys are curious about the math, my portfolio, if I didn't earn a single cent, it would grow to $33,200 after 3 years with just these deposits. So I need to earn about $17,000 in 3 years. So I've calculated my gains need to be about 40% every single year, and that's going to be very difficult to hit. However, the baseline for this is at least to beat the TSX index to prove that I myself can invest better than the index does. But currently, things are not looking so hot. My portfolio as of today, I'm actually down by 1%, so I haven't even made a single gain yet. But over the past year, this has fluctuated quite a bit. There's times when my portfolio was up by about 8% and I was beating the index, and other times I was down by 8% and losing to the index. And if you're wondering, how do I plan to catch up if my portfolio, I haven't even earned a single cent on it? Well, here are the 4 strategies that I could take, and I'll tell you which one I'm going to choose going forwards. The first strategy is to do day trading, and this is to make up for some lost time and hopefully get some quick gains and lock in those profits. The second method is a little bit similar, but doing swing trading. This is on a slightly longer time horizon, like a week or 2, where I hold a position and hope that because of technical analysis, a week later or 2 weeks later, it goes up and I sell for profits. Both these strategies are quite risky because you can lock in losses as well. Things aren't always going to go rosy, and a lot of macroeconomic events you can't always predict, and they could crash the market. And at that point, you might be bag holding some stocks that are not exactly the wisest investments. So for me, the strategy of depositing $200 every single week and investing in my long-term convictions is the strategy that I'm going with. Now, I mentioned there were 4 strategies, and here's a 4th strategy that I could employ. However, right now is not exactly the best time for that. And that is to buy growth stocks. Growth stock investing would be buying and holding these high growth stocks where the companies are more interested in growing the revenue than the bottom line. Right now, I personally don't think it's a good time to get into growth stocks to get some quick gains in the next couple of years because of the huge run up that we saw in growth stocks in the past year or 2. Investors right now are cooling off from growth stocks and they're still falling a little bit. And typically I see growth stock cycles out there happen every 3 to 4 years. So if I'm hoping to grow my portfolio by the end of 3 years or 2 years out from now to $50,000, then I don't think growth stocks are going to bring me there. So to elaborate a little bit more on my strategy of buying and holding these long-term stocks that I have high conviction in, basically the stocks in my portfolio, these are the ones that I've picked so far. And when I look at these stocks and just look at their relative performance over the past couple of weeks or past couple of months, the stocks that I notice that are down the most, those are the stocks that I start to look at to see if there's any value there. Because if I bought them at a previous price that was higher, and today's price they've come back down, if I still have a high conviction in that stock, why am I not buying more right now? And that's the question that I ask when a stock in my portfolio is down. Do I still like the business for what it is today? Are there any major changes in the business that could affect its long-term trajectory? And if I answer yes to the business and no to the long-term changes, then I will continue to buy that stock. So for me, this is my strategy that I'm sticking to for the next 2 years until the end of this challenge, and honestly, probably going to stick to this for 10 or 20 years. But if you guys are fairly risk adverse, there's actually a pretty good option out there right now where you can invest your money risk-free. Well, basically risk-free. And that is through EQ Bank. Recently, EQ Bank has raised their interest rates for their high interest savings account to 1.5%. If you purchase one of their GICs, you can go for as long a term as 10 years, and that will yield you 3.85% each year. If you don't want to invest for 10 years, well, you have other options, anywhere from 3 months to 10 years, and these interest rates vary, as you can see on the screen. I personally use EQ Bank, and they have some of the highest interest rates for a savings account that's not part of a promotional offer. There's some other accounts out there offered by these no-name companies, but EQ Bank is backed up by a large bank, so there's some trustworthiness there. For a limited time only up until May 2nd, if you follow 3 steps, you can earn up to $150 for signing up today if you use the link below in the description. And as interest rates continue to rise over this next year, the GIC rates should only get better and better. There might even be a point in time where I start pulling money out of my investments and putting them to GICs because they just make a little bit more sense. But there still are stocks out there where I have a long-term conviction about, where I think the story and the fundamentals behind the company are worth noting. And the next 3 stocks are my highest conviction stocks in this portfolio of mine. The first one being Shopify. Although Shopify used to be trading at around $1,700 to 2,000 Canadian dollars per share, it's currently dropped back down to about $800 per share. However, the long-term prospects for Shopify are amazing in my opinion. They're conquering the e-commerce market right now and possibly going to steal market share from Amazon. The reason why they have an advantage over Amazon is because companies with great brands will go to Shopify, set up a store, and that branding is so important for e-commerce. When you're looking for a product on Amazon and you're scrolling through the page, they all pretty much look the same and they have some unknown brand behind them. But companies out there that actually have a brand presence and they have their own unique product, they're more than likely going to go to Shopify because you can set your product apart on there and tell your story. And when people buy products, they're more inclined to buy a product where they're connected to the story with and actually use that product. The biggest barrier though for Shopify merchants right now is fulfillment. So when Shopify figures that out, like warehousing and shipping, and makes it a lot easier for merchants to do, then I think this is where we're going to see a hockey stick explosion in Shopify's revenue. My second highest conviction in my portfolio right now is Air Canada. And this is a post-pandemic play. We're not fully out of the pandemic right now because there's still a lot of travel restrictions and people are a bit weary of traveling. So I think in 2 years from now, we're definitely going to get out of that, or for the most part, we should be out. And this is when investors will start piling back into these travel stocks because there is this pent-up demand for travel. Currently, investors don't yet see that return to travel where it's exploding, but once this starts happening, this is when investors are going to flock back to airlines and hotel stocks. The third company which I have a high conviction about is DCM, or Data Communications Management. This company is a small company, almost a penny stock, but it's got great fundamentals. The company is cash flow positive, they're also earning a net income, and they're very cheap for what they're doing right now. The company went through a turnaround with a new CEO who slashed the number of employees as well as killed a whole layer of management. So that's a lot of salaries saved. On top of that, they've paid off a good chunk of debt, about 50% of their debt in one single year. The company earns about $250 million in revenue, while the market cap is only $60 million. Right now, they're taking home about $1 to $2 million in net profits, as well as their cash flow is about $4 million on average per quarter. So all in a single year, the cash that hits their bank is about $16 million, which is about a quarter of the market cap. If you're new to investing, here's some tips that I have for you. If you're not interested in these, you can just skip on ahead to see my portfolio. Tip number 1 is to not let market news scare you and read between the lines. You need to figure out if this piece of news is going to affect your portfolio for the time length that you've set aside for this portfolio. So if you want to grow your portfolio in 1 year, then yes, short-term news is going to affect your portfolio. Tip number 2 is to stay consistent with your plan. If you've mapped out a strategy and you've got a time frame for it, then at least stick to your strategy for that time frame and only change that strategy if you have a really good reason. Tip number 3 is to know your risk and play within it. If your risk is high and you want to go all in one stock and you don't care about the money, then by all means. But if you're not a super confident investor and you want this money for your retirement and you can't afford to lose it, then I would highly suggest diversifying that and possibly just investing in an index fund. Tip number 4 relates a little bit with tip number 3, but don't be afraid to make mistakes. I think a lot of people don't start investing because they're scared of losing their money. And this is where you should start figuring out how much risk that you can take. For the money that you're willing to lose, then you can possibly just gamble it away. But for the amount that you're not willing to lose, at least start investing in safer investments like index funds. Playing with fake money is a lot different than playing with real money, because there's a lot of emotions involved with real money. So the way to start is to at least start with a small amount and play within your risk. Tip number 5 is to keep an emergency fund. Just like I mentioned before with EQ Bank, I keep an emergency fund because in case I've got financial needs that I need to meet in the very short term and I lose my job, for example, at least I have cash on the sideline that I can use to pay those things and not have to sell my stocks at a loss if it's a poor time in the market. So now this is the moment that you've all been waiting for. If you haven't seen my portfolio, here it is. This is a spreadsheet of my portfolio. Currently the total market value is $13,050.60. You can see all the different stocks and how they're weighted in my portfolio, and it's fairly diversified. No position is larger than 10% in this portfolio. As for sector weightings, you can see the largest sectors are the technology sector at 22.3% and finance at 19.6%. Currently, my portfolio change based on the spreadsheet, I'm actually down by 3.77%. In dollar terms, that's equal to about $511. So far, I've collected $140 in dividends. The total yearly dividend I estimate to collect every year is $214.54. Now, sorting my portfolio here by the percentage return, you can see my top performers are Dollarama, TELUS, as well as Ryokan. And my worst performers are Good Nature Products, Shopify, and Enghouse. As I told you earlier, I'm very bullish on Shopify and I'm doubling down on this position. Good Nature Products is a very small position of mine at around $200 book value or $100 right now today. This is a wild card play that will probably play out in the next 5 to 10 years, but I honestly don't expect too much in the next 2 to 3. Enghouse Systems has gotten hit, and possibly because investors are viewing it as a pandemic play, and they got a huge boost in revenue through the pandemic. However, they do pay a nice dividend of 2%, and they are cash flow positive, and their P/E ratio is around a 20 for a technology company. So it's not too shabby, and I think right now at these levels, it is a little bit undervalued. So overall, my portfolio has some major swings in it, and typically these are the more riskier stocks where I'm losing a lot or gaining a lot. Although in this case, TELUS up by 21%, I think that's just luck of the draw. When I started this account and buying into TELUS, most of the dividend and telecom companies were recovering, and therefore that's why I saw a 20% increase in this stock. I honestly don't expect too much going forward in the next 2 years, maybe a 5 to 7% gain on top of this, but really I'm invested in TELUS for the dividend yield. Going forwards, I'll be posting regular updates on my portfolio, as well as doing deeper dives into interesting Canadian stocks out there. If you guys have any suggestions, please leave them in the comments down below. Otherwise, subscribe if you want to follow along my journey.